Good afternoon, my name's Craig Earle, I'm market analyst at ALPARI UK, and welcome to today's daily update on the markets. Today we're going to look at the major stories affecting the financial markets over the last 24 hours, and no story comes bigger than this Barclays story. Barclays were fined a record £290 million for the part they played in the manipulation of LIBOR rates. Now, LIBOR rates are calculated by the 20 largest banks inputting rates at which they believe that they can borrow in the market, and an average of these rates is used to determine things like mortgage rates and credit card rates, and a manipulation of these numbers can be used to the benefit of these banks, as we've seen. Barclays also apparently manipulated these rates following the collapse of Lehman Brothers to paint a false, improved picture of how well their bank was performing. So again, it's painting a false picture to the markets and painting a false picture to the consumers. So today we've seen the results of this fine. We've seen Barclays trading down around almost 11% now, and we've also seen these other banks fall with it, because as we've seen as we've seen over the last couple of years, bad news for one bank tends to lead to the collapse in the share price of other banks that could potentially be associated with the story as well. And we have seen in these stories today that other banks are being investigated for the same reasons, so we could see stories develop over the next few months again. Now, like I say, this is going to have a big impact on the FTSE. We've seen the FTSE trading down around 1.5% today, weighed down heavily by these banking losses, with the banks being heavily weighted in the FTSE itself. And we've also seen other indices trading down as well, such as the CAC and the DAX. But again, this could also be due to what we're seeing in the Eurozone. We've got the Eurozone summit today and tomorrow. It's due to start later this afternoon, so we've got no more stories out about that yet. But there is a number of things set to be discussed at this Eurozone summit, such as how we can turn a corner in this Eurozone crisis at the moment, be it short-term solutions or longer-term solutions as well. It's believed that Angela Merkel wants to form more of a fiscal and political union before she'll start discussing the idea of mutualising debt, whereas in France and Italy and Spain, their main focus at the moment is trying to bring down these high Spanish and Italian bond yields, which could eventually freeze them at the markets and lead to the countries requiring a bailout, which which a lot of people don't believe there is enough money in these bailout funds to support these bailouts. So the main focus for France and Italy and Spain at the moment is to bring these bond yields down. But this is also the reason why we don't think we'll see any real solution out of this. I mean, Angela Merkel has shot down the idea on numerous occasions about using the EFS or the ESM to bring down these bond yields by purchasing these government bonds in the secondary market. We've seen the ECB say that they're not going to interfere in the market. It's not up to the ECB in order to bring down bond yields of these struggling countries. So we could see a bit of a stalemate at this summit, which means we might not actually see anything come out of it, as we've seen with previous summits as well, which is why we've seen no optimism in the markets as we lead up to it, because people just aren't really sure what's going to come of it. We'll probably see a bigger reaction tomorrow afternoon once we start to hear stories out, but for now the markets are relatively muted in respect to this. However, we have seen in the bond yields, though, with these summits coming up, we have seen that Spanish yield creep up to around 7% again. It jumped just above 7% this morning. It's fallen a little back behind now, but we can expect it to trade around that 7% mark again. Italian yields are trading around 6.25%, but again, we can expect them to start rising over the next couple of days if we don't see any resolutions or any stories or any positive news coming out of this summit over the next 24 hours. Elsewhere, we've had some data out today. We've seen some German unemployment data. The German unemployment went up by 7,000 in the last month. So again, it's a bit more negative news for the Germans. It means that they are still being sucked into this crisis. This is more confirmation now that the Germans are susceptible to this crisis, and they are finally being dragged in despite having such a strong first quarter. And we've seen this affected in the euro. The euro has fallen off again today, and it's trading around 124. So again, it's fallen back from around 133 a couple of months ago, now trading around 124, especially now that the Germans have been sucked into this crisis, which they hadn't been up until now. Elsewhere, we've also seen in the UK, we've seen that confirmation that that final GDP figure, which confirms that we are now back in a technical recession. And we've also seen house price data, which is the nationwide HPI for last month, which showed that house prices did fall by 0.6%. Again, this is bad news again for the banking sector, who, with the banking sector having such a high exposure to the property crisis, which came as a result of the 2008 collapse. So again, we've seen this reflected in the cable charts. We've seen sterling fall back, and it's now trading around 155, and we may see it start to fall back a little further over the next week or two. But other than that, we're just going to be looking ahead now to this, the results of this Eurozone Summit over the next 24 hours. So until tomorrow, my name's Craig Earle, I'm Market Analyst at ALPARI UK. Thank you very much for joining us.